Good afternoon and welcome to Shining Australia's 2020 Tax Update webinar from wherever you are. It's great to have so many of you on the line today. I'm Stephen O'Flynn, the National Head of Tax here at ShineWing, and I'll be moderating today's session. This is the first of our two year-end tax seminars and will provide an update on the key tax changes that have arisen in the last 6 months that you should be considering as we come to the year end. The second session will be run on Thursday, the 11th of June at 2 p.m. and will focus on practical year-end planning issues in the COVID-19 environment. Our presenters today are from across the ShineWing national practice. Firstly, Matt Birrell will provide a recap of the COVID-19 measures that have recently been announced. Helen Wicker will then present on recent ATO rulings and tax cases. And finally, Tim Hogan-Doran will be presenting on international tax developments. Before we start, I would like to run through some housekeeping. The slides will be sent around to all attendees at the conclusion of the seminar. We recommend that you click on the Enter Full Screen button at the top right-hand corner to achieve the best webinar experience. We have a fair bit of content to get through today, so I'll be utilising the Q&A function to answer any questions. We encourage you to ask questions using the Q&A, but we might not have time to get through all the questions today. If you click on the Q&A button, it can be found at the bottom of the screen, and a window will pop up that will allow you to send us any questions as we go. We'll monitor these questions and answer them if we can during the presentation. Some we'll save for the Q&A at the end of the session, but for more bespoke questions, we may need to contact you after the session. Now I'd like to hand over to Matt Birrell to provide the recap on COVID-19 measures.
Thanks, Stephen, and good afternoon to all of you. I'd like to spend a couple of minutes recapping the federal government's response to COVID-19, and this response occurred over a number of tranches, and then I'll drill down into a couple of measures in further detail. The government markets its response to the crisis under these headings: support for the flow of credit, support for individuals and households, support for businesses and employers, and support from the ATO. With respect to the support for the flow of credit, you may recall that the government's initial response was to ensure there wasn't a repeat of the GFC and that there was sufficient liquidity in the market. They did this through introducing the SME Guarantee Scheme, which was a scheme where the government guaranteed 50% of a loan up to $250K to a SME borrower, the relaxation of certain responsible lending criteria to existing small business customers, the release by the RBA of a term funding facility for the banking system that enabled banks to access around $90 billion in funding at a fixed rate of 0.25%. The government also provided around $15 billion in funding for investment into the structured finance markets, typically used by the small lenders. The government's policy with respect to the support for individuals and households included the JobKeeper payment, increased income support that included the $550 coronavirus fortnightly supplement, some suspension of eligibility requirements for the job seeker payment, and the ability of accessing superannuation early. For businesses and employers, the government released a number of packages, including wage subsidies in the form of both the JobKeeper payment and a 50% subsidy for the wages of apprentices and trainees for a period of 9 months. The cash boost payments were introduced, which are payments between $20,000 and $100,000 in 2 tranches available to eligible businesses that had employees subject to withholding. Importantly, the cash boost payments are only available to those businesses with an aggregated turnover of less than $50 million. And because the payments are received automatically, we're aware of a number of taxpayers that have been receiving these payments where their global income is greater than $50 million. And the question we often get is, what do we do with the money we've received And unfortunately, the answer is you've got to give it back. Similarly, some taxpayers that are entitled to the cash boost haven't received the amount. So a review of your eligibility for the cash boost can be warranted. The government also provided temporary relief to various financial distress rules, such as the insolvency rules. They released investment allowances in the form of the instant asset write-off concession and also accelerated depreciation concessions, which we'll come to in a moment. And again, for business, the SME guarantee scheme was released. Finally, the last plank of the government response is the ATO support, which has been undertaken through lodgement deferrals, payment deferrals, and remissions. Drilling down into a bit more detail on a couple of these, first, the instant asset write-off. From 12 March of this year through to 30 June, eligible businesses can fully write off assets with a cost of $150,000 or less. This concession was introduced by the Coronavirus Economic Response Omnibus Act of 2020. You might recall this is the bill that was rushed through Parliament as we went into lockdown. The write-off is only available to businesses, i.e. you must be carrying on a business. Merely operating a passive investment business isn't going to be enough. This incentive is available to all businesses with an aggregated turnover of less than 500 million. Now, this term aggregated turnover is popular and is being used a bit. It's a defined term and it effectively means the turnover of the entity and all entities that are connected or affiliated with that entity. Connected is defined to be a 40% more interest, and these tests operate on a worldwide basis. So this incentive is available to those entities with a global group turnover is less than 500 million. And the incentive is available to both new and to second-hand assets. Now, tracking the timeline of these incentives is a task in of itself. And I'm going to work out from the bottom up on this table. So the instant asset write-off began life as an incentive available for small business, which was defined as less than 10 million, and up to 28 Jan 2019, the threshold was $20,000. You can see as you work your way up the table, the concession has gradually expanded in both the type of business that's eligible. It became available to medium taxpayers from April 2019, and then of course to large taxpayers now. And also the threshold has increased, growing from the initial 20K to 25K to 30K and now to 150K. For large and for medium businesses, it's worth noting that the contract to enter or to acquire the assets must have been entered into prior to 2 April 2019. So if you entered into a contract for an asset in March 2019, but didn't actually install it ready for use until just this month, for example, you wouldn't be entitled to the instant asset write-off. The government has also introduced new accelerated depreciation rules. These rules provide for an immediate write-off of half the asset in the year the asset is purchased, with the remaining 50% depreciated over the asset's effective life. The rules apply to assets purchased after 12 March 2020 and first installed or used by 30 June 2021, so 30 June next year. Similar to the instant asset write-off, this concession is only available for those businesses that have an aggregated turnover of less than 500 million. A couple of important differences from the immediate instant asset write-off rules. There's no cap or threshold on the asset cost. So if you've purchased a $5 million asset in the past month, you wouldn't be entitled to an instant asset write-off, but you might be entitled to a write-off through these rules. This is only available to new assets. It doesn't apply to second-hand assets. And these rules don't apply to contracts entered or commitments prior to 12 March 2020, unlike the instant asset write-off rules that allow you to have a contract entered into as far back as April 2019. So as I said, keeping track of the dates is a job of itself. What I've done here is put on a table for large taxpayers. So this would be if your turnover is between 50 and 500 million, and the business first used or installed an asset between 12 March and 30 June this year. You can write the asset off if it's less than 150,000. If the asset was over $150,000, you can deduct half of it this year, providing the contract date was after 12 March 2020. For assets first used and installed between 1 July 2020 to 30 June 2021, then you can also deduct half of the asset in the 2021 year. There are similar tables here for medium businesses and small businesses, which are for your reference. Probably the most significant piece of legislation we've had in tax for many years is the JobKeeper scheme. Now, I'm sure many of you, if not most of you, have been to webinars and updates on JobKeeper, so I'm not going to prolong these slides. As most will know, JobKeeper can apply where an eligible business employs an eligible employee and that business meets the decline in turnover test. Where a business is eligible, it's entitled to $1,500 per fortnight per employee. Meeting and understanding the turnover test has posed probably the greatest challenges to the program. The rules again rely on this concept of aggregated turnover, where that turnover for a business is less than $1 billion, a 30% decline in turnover is required, and 50% if over $1 billion. With respect to where we sit today with JobKeeper, organisations will have done testing for fortnights 1 through to 4, which is the months of April and May. So most organisations that will qualify will now be in the system. For business groups, particularly those with a group employing entity, the rules aren't what I would describe as elegant. They have holes that require some assumptions and some leaps of faith to determine applicability. The ATO has released a couple of guidance notes, in particular PCG 2024, which talks about what the ATO considers to be acceptable or unacceptable behaviour in making some of those assumptions, or performing or not performing particular actions in order to engineer a result. The guidance note is helpful, but at the end of the day, there are only 10 examples in it, and you could probably give 100 examples, and still that wouldn't be enough to deal with the many issues out there in the market. The ATO has also released LCR 2021, which provides further details with respect to the decline in turnover test and different options to use in relation to the calculation of turnover, which does not necessarily need to be a comparison of a BAS statement from one month to another. The ATO provided further guidance on the modified decline in turnover test over the weekend, which provided some limited guidance on incidental and main business. Of course, we welcome guidance, but the truth is that most organisations that are going to qualify for JobKeeper had to lodge their claims before the guidance was released. So there'll be some organisations that may find themselves having lodged claims based on an honest interpretation of the rules, which may subsequently be contrary to the views expressed by the ATO. And a decision would need to be made on whether to pay back what's been received. My final comment on JobKeeper before handing over to Helen is that if you have claimed JobKeeper, you must document it. Document the turnover calculation, document the methodology, and document the technical aspects. This will spare a lot of pain if and probably when the ATO start their reviews. And with that, I'll hand you over to Helen.
Thanks, Matt. I'll take you through some recent ATO rulings and guidance, as well as some tax cases this afternoon. The ATO has, as always, been busy and issued numerous rulings and guidance over the time since our last tax update. We've given you a full list of the final ones issued. The only one I'll mention in any detail as far as the practical compliance guidelines is PCG 2020 number 3. This one gives, instead of a standard hourly tax deduction rate of 52 cents per hour for working from home activities, during COVID-19, we're all able to claim a massive 80 cents per hour for the costs where we're working from home as a result of the current situation. So the additional buffer to 80 cents above 52 cents covers additional expenses such as computer consumables, stationery, and so on. So if you're looking at preparing your own personal tax return soon, that's something to take into account. But don't forget to keep a record of the hours that you've been working and the breaks taken. First taxpayer alert to take a brief look at is Taxpayer Alert 2020 number 1, and it looks at non-arm's length non-arm's length arrangements and schemes that are connected with the development, enhancement, maintenance, protection and exploitation of intangible assets, or DEMPE. It's always nice to have a new acronym to discuss. So just one moment. I've just managed to change my view here. This particular ruling looks at the circumstance in a world where intangible assets are increasingly important, and appropriate allocation of cost and income flows for such intangible assets is critical for tax purposes. And this is an issue that's considered by the BEPS project. The principles considered in this taxpayer alert are consistent with the OECD's conclusion that taxation should be aligned with the transaction's economic reality, rather than strictly focusing on the legal arrangements or legal contractual terms. The taxpayer alert outlines the ATO's concerns with arrangements that bifurcate intangible assets, so split them between jurisdictions, and possibly mischaracterise Australian activities. This can also involve the non-recognition of Australian activities. The ATO has identified a number of circumstances where they have concerns about how the various functions have been split and whether this results in an inappropriate tax outcome. To give an example, imagine a situation where an Australian company owns and derives income from a suite of intangible products, valuable patents, trademarks, know-how, etc. AusCo then enters into a contract research and development arrangement with an international related party and is paid on a cost-plus basis to develop further intangibles for that foreign company. AusCo continues to receive income from the existing intangibles, but reduces its DEMPE activities associated with those and instead focuses on developing the new intangibles for the foreign company. The new intangibles are intrinsically linked with the old ones because they're updated versions and enhancement of the existing intangibles. So the substance of what AusCo does doesn't change. It continues to develop intangible assets, but now the ownership of those assets and the future income flow accrues to a related overseas party rather than itself in Australia. The value of AusCo's own intangible assets also continues to decline as the newly developed intangibles effectively supersede the older ones. So the ATO's concern here is that there's a transfer pricing concern, so AusCo may not be adequately remunerated for the functions it's carrying out if it's only paid on a cost-plus basis. In addition, there's a possibility that the ownership of the existing intangibles might have been migrated to the foreign associated company without a proper recognition of gains under capital gains tax or depreciation provisions. There's also a concern that the arrangement may not be commercially rational and may fall foul of the general anti-avoidance provisions or diverted profits tax. So I think a couple of really interesting parts here. I think the focus on migration of assets, this is something that I've had a concern about in a number of client circumstances, but it's the first time I've seen it spelled out by the ATO. Another circumstance where this sort of thing can potentially come into play is where a business is allowed to wind down in one entity and start up in another, so an in-substance transfer of goodwill. The other notable point is that this is a further illustration of the fashion to reach for the general anti-avoidance rules in every tax situation. When they were first introduced, the general anti-avoidance rules were very much a provision of last resort and rarely invoked, but now Part 4A is a standard concern trotted out by the tax office. Our second taxpayer alert looks at mischaracterised arrangements and schemes connected with foreign investment into Australian entities. This focuses on arrangements where the ATO's concern is that investments into an Australian entity may be structured so as to avoid Australian tax on the return to the foreign investor, or obtain a tax deduction for the Australian entity in a way they see as inappropriate. So this may encompass a range of evils, from failure to comply with dividend or interest withholding tax, and in substance capital gain may arise but not be recognised as a result of a grant of income from a right to mining. The creation of instruments that are not characterised as debt for thin capitalisation purposes, or a failure to apply arm's length transfer pricing or conditions. They may also be structured to avoid a requirement to disclose to the Foreign Investment Review Board when an equivalent ordinary equity interest or option to acquire an asset would in fact need to be disclosed to FIRB. The general feel of the taxpayer alert is, if it's not plain vanilla, we don't like it. To illustrate with one of the examples in the alert, an Australian entity raises investment funds from an offshore entity. While ostensibly debt finance, the return payable is at interest rates which exceed those which would normally apply on traditional debt investments. In addition, there's a contingent return payable if the Australian entity sells its assets, and that return reflects a share of the sale proceeds. The contingent return is treated by the Australian company as not subject to Australian withholding tax, but it is treated as either a deduction or a cost base increment to reduce the eventual capital gain. As a further twist, the payment of interest may be deferred until the sale of the asset occurs, which of course defers the time at which interest withholding tax would apply. So you can see why the ATO would have concerns. As with all taxpayer alerts, the ATO has issued these as a sort of quick communication to the market. They have concerns in this area and that they'll be doing further work on it. In many cases, they'll reach out to taxpayers to try and understand what they're doing and then eventually come up with a ruling or determination on their final view. The ATO, I've just given you a list of ATO draft rulings and guidance issued of late. The only one of those that I will focus on is TR 2019 D6, labour costs related to the construction or creation of capital assets. This draft ruling is likely to significantly impact mining and energy infrastructure and construction businesses. Now, the starting point of this document, that where employees are specifically engaged for constructing or creating capital assets, those costs are capital and taken into account in determining the cost of the asset, is quite straightforward and would generally be accepted. But things get tricky when the question of fact and degree or apportionment of cost come into play. The draft ruling doesn't just require the capitalisation of costs where employees are specifically engaged for a particular project. It also takes the view that the nature of the activities of an employee can change over time, from capital to revenue and back again, and that in certain circumstances an apportionment may need to be made between the capital and revenue activities of an employee from one day to the next. And this might be where employees are specifically employed to both construct assets and other duties such as maintenance. The focus of the draft ruling is on the essential nature of the costs, the essential character of the costs at the time the expenditure is incurred. But one of the more worrying examples is of a group of electricians who are engaged to both maintain and construct capital assets. Based on timesheets, 50% of their costs are capitalised and 50% expensed for accounting purposes. The implication is that the taxation treatment of this expenditure should be determined in the same way as the accounting treatment. No doubt this is going to increase compliance costs of taxpayers, and I know there have been many submissions made in response to the draft ruling. There's very little guidance as to the level of detailed inquiry that's required to be made, and I suspect that the issue of the ruling has very much come about because the ATO is concerned. It's seen a number of examples where there's been a somewhat aggressive approach that labour costs are always inherently deductible. The draft ruling does consider issues such as the extent to which costs are capitalised in accounting records, and they see that as being a relevant consideration. I don't think that there's a robust discussion in the ruling of what I would regard as strong support for this in case law. I'd also observe that accounting capitalisation for post-acquisition expenditure tends to look for whether there's been an improvement in the state of the asset compared to what it was immediately before incurring the expenditure, whereas tax law looks at the comparison between the state of the asset at the time it was acquired and then after the expenditure is incurred. So I think I'm hoping that we'll see quite a bit of additional guidance material provided before that ruling is finalised. Moving on to cases. Our first case is Greensill's case, which is to do with a discretionary trust. So Greensill was the company concerned acted as trustee of an Australian resident discretionary trust. And the question was, are capital gains on disposal of assets that are not taxable Australian property accessible when distributed to a foreign resident beneficiary of an Australian discretionary trust? You'd be aware that Australian tax law generally works on the principle that residents are taxed on worldwide income, non-residents only on Australian source income. There are exceptions, but that's the key principle. When it comes to capital gains, the very broad principle is that non-residents are taxed only on capital gains from taxable Australian property, TAP, which is largely interest in Australian real property and business assets of a non-resident. However, this treatment essentially only applies where the non-resident realises the gain directly, as Greensill's case demonstrates. The facts are relatively straightforward. An Australian resident discretionary trust owns shares in an Australian company. That company owns shares in UK companies and other entities both in Australia and overseas. The shares owned by the Australian Resident Discretionary Trust were disposed of from 2015 to 2017, and the capital gains were distributed to a non-resident individual beneficiary of the trust. There was also, some shares were also distributed in specie to the non-resident beneficiary. My understanding is that there was an intention for these to be provided to employees of the underlying businesses. To give you an idea of the quantum involved, in 2015, the trustee disposed of shares which had been acquired for a cost of 10 cents for total consideration of just over $13 million. As a result, capital gains of $13 million were realised. The equivalent gains in 16 and 17 were in the order of $10 and $35 million. Now, the starting point in this case is the principle that if a beneficiary of a trust is a non-resident, the trustee is taxed on the beneficiary's share of that net income, more or less on behalf of the non-resident beneficiary. And generally speaking, the non-resident is taxed only to the extent that the income is Australian source. The beneficiary is also taxed and receives a refundable credit for the tax paid by the trustee. Now, looking at taxing of trust capital gains, the rules introduced after the Bamford decision means a beneficiary's taxable income is determined using the capital gains tax provisions rather than the trust rules for income. So this means that source rules don't apply. In addition, unless the trust itself is a non-resident, the taxable Australian property rules don't apply to the gains realised by the trust. So the outcome of this case was that capital gains distributed to the non-resident beneficiary were taxable in Australia, notwithstanding that the gains wouldn't be taxed if that beneficiary had owned them directly. And of course, the really nasty point is that the capital gains tax discount does not apply to non-residents after May 2012. I will mention this case considers a gain realised by a discretionary trust. Taxable Australian property rules do allow the disregarding of non-TAP capital gains by a non-resident beneficiary where those gains are realised through a fixed trust. I'll also mention that the ATO has issued a couple of draft determinations, TD 2019 D6 and D7, one of which considers this issue and the other confirms confirms its position consistent with the decision in Greensill. And the second confirms the Commissioner's view that the source concept does not apply to treat a foreign capital gain as not being accessible where realised by a discretionary trust and distributed to a non-resident beneficiary. Our next one is not so much a case decision, but a decision impact statement has been issued by the ATO in relation to Burton's case. The Burton's decision from 2019 confirmed that the taxpayer concerned was not entitled to a full foreign income tax offset for US tax paid on discounted capital gains on the sale of investments, as only half the capital gains had been included in his assessable income. So this meant that in the US, tax was paid on the whole of the gain, and under US rules, effectively the tax was only paid at half the rate that applies to normal gains, where in Australia, only half the gain was taxed and only half the US credit was available. So this means that taxpayers can only claim a foreign income tax offset to the extent that the foreign capital gain is also assessable in Australia, rather than the full amount of the tax paid in the foreign jurisdiction. And as I mentioned, this unpleasantness of this decision can really only be appreciated when it's realised that the US provides a concession for taxation of long-term capital gains by applying a lower tax rate, whereas Australia discounts the amount of the gain that's taxable. The ATO's decision impact statement notes that the case decision reflects the Commissioner's view of the law as it was reflected in a 2010 income tax ID, ATO ID. Submissions are due by tomorrow if anyone still would like to make a submission in relation to that decision impact statement. Looking briefly at BHP Billiton, you would all be familiar with BHP Billiton as a household name in Australia. You're probably aware that BHP Billiton Ltd Australia and BHP Limited PLC, a UK company, were part of a dual listed company arrangement for the purposes of conducting their combined businesses. This particular case considered the Controlled Foreign Company or CFC provisions. We had a structure where we have the Australian listed company, the UK listed company, and a Swiss subsidiary company. It's an indirect subsidiary, which is 58% owned by the Australian parent company and 42% owned by the UK company. So it is 100% owned by the combined group. This Swiss company, which I'll call BMAG, purchased commodities from the Australian subsidiaries of both BHP Limited and PLC, the UK company, for sale into the export market. There was no dispute in this case that BMAG was a CFC of the Australian company, that the Australian company was an attributable taxpayer, and that tainted sales income would be included in the Australian assessable income. But the question was whether the income derived by BMAG from the sale of commodities it purchased from the Australian subsidiaries of the UK company were also tainted sales income. For that to be the case, the Australian subsidiaries of PLC, the UK company, had to be associates of BMAG as well. That question turned on whether BMAG was sufficiently influenced by both the taxpayer and BHP PLC. In terms of the definition of associate, the key question is whether the term sufficiently influenced requires an element of control. The High Court found that to be sufficiently influenced does not require strict control. The dual listed structure and associated agreements in the BHP case meant that the Australian and UK companies operated as combined business, a single unified economic entity through common boards of directors and unified senior executive management. Therefore, each company was sufficiently influenced by the others. The sales of the commodities from the UK company's Australian subsidiaries were goods acquired from an associate. Therefore, the income was tainted and attributable. So this decision does look at this articulation of the meaning of the term sufficient influence in the definition of associate for many purposes of the Australian tax legislation, and there's sure to be broader implications for entities with common boards, common economic ownership, and the mutuality of interest in play. Our final case is a brief mention of the Origin Energy decision. The particular facts are not so much the thing that are going to be relevant to people, it's the principles involved here that are important, as is usually the case with tax decisions. Origin paid a significant amount for the net present value of all the annual capacity charges payable for the generation of electricity over 28 years. And the question was, Origin contended that the payments were for the long-term supply of energy and were therefore deductible. In the alternative, if they were capital, Origin thought they should be deductible over 5 years as black hole expenditure. The court found that the charges were in fact capital in nature, and the expenditure resulted in the extension of the profit-making structure of the business. The expenditure was not merely for the yearly acquisition of electricity for on sale at a profit, even though that was part of what was acquired. And also, because what was acquired was a bundle of contractual rights, this gave rise to CGT assets, and as a result, the capital outgoings were not eligible to be claimed as black hole expenditure. I don't think this is a particularly contentious case, but it is a timely warning to consider whether amounts paid which are capital are able to be treated as deductible black hole expenses, or whether the exclusions to those provisions apply. The black hole expenditure provisions don't operate to give a deduction for a broad range of capital expenditure, but they're only intended to provide a deduction for amounts that would otherwise fall into a black hole and not have other tax recognition. If the cost forms part of a CGT asset, it can't be claimed under the black hole expenditure rules. It's also an illustration of how important it is to consider tax impact when structuring acquisition contracts. The overall effect of this case is that Origin paid nearly $900 million for the right to obtain electricity supply over a 28-year period, but the outgoing ended up being treated as a cost of a capital asset. The capital loss that will arise when the asset expires is going to be of cold comfort to the electricity generator in future. I'll now hand over to Tim Hogan-Doran, who will look at international tax developments.
Thanks, Helen. I'm going to cover off today, from an international perspective, developments that relate to Australian companies that are investing outbound and foreign companies that are investing inbound into Australia and the relevant laws that impact them. Firstly, I'll cover off some of the significant global entity rules that have recently been enacted. I'll cover off through the hybrid mismatch in both the structured arrangements and some target integrity rules where there's some draft determinations out there still. I'll then turn to thin capitalisation and a recent tax determination around the valuation of debt capital. I'll quickly cover off the OECD's released transfer pricing guidance for financial transactions. And finally, I'll cover off the ATO's compliance approach to the ALDT and COVID-19. Firstly, turning to significant global entities, just last week or so, Treasury Laws Amendment 2020 Measures Number 1 was passed into law and received Royal Soil assent. This means that more entities will now be subject to both the country-by-country reporting and general purpose financial statements obligations in the coming years, as from 1 July 19. Equally so for these new entities covered by the rules, they'll be up for penalties up to $525,000 per late filing of a document. The current law as it is in terms of which entities are SGEs is that if you're a member of a group of entities that are consolidated for accounting purposes and another member of your group is a global parent entity that is an SGE, that is, it has an annual global income over $1 billion, you are captured under the current laws. Under these new amendments in the laws, you're also an entity as an SCG also if you're a member of a notional listed company group. And again, another member of the group is a global parent entity that is an SGE. So a notional listed company group is a group of entities that would be required to be consolidated as a single group for accounting purposes if a member of the group was a listed company and certain exceptions to the requirement to consolidate were disregarded. The key exceptions here are, in this case, in this scenario here entity A is not required to consolidate with entities B, C, and D for accounting purposes as it is an investment entity. Equally so, entity D is also not required to consolidate with entities B, C, and D for accounting purposes as it is an immaterial entity. You'll commonly see this in the situation where we have some inbounds where either there's a significant individual offshore, a trust offshore, and again, or an entity offshore, which is treated as an investment entity. Equally so, commonly in Australia, you may see a small subsidiary of a global multinational, which is currently not being brought into the accounts as it is considered immaterial. However, these exceptions are disregarded where entity A is now assumed to be a listed company. So in this scenario, entities A, B, C, and D form a notional listed company group. Furthermore, this law also sees an extension of the application of the CBC reporting for entities. Currently, entity must undertake CBC reporting and may be required to provide GPFS if it is an SGE. Under these new amendments, an entity must undertake CBC reporting and may be required to provide GPFS to the Commissioner if it's a CBC reporting entity as defined. Broadly, that is the case where it would be an SGE if, again, the notional listed company group's rules did not disregard to the exceptions to consolidation, other than materiality rules, and did not include individuals. So taking that example forward again a bit further, in this scenario here, with respect to entity A, despite entity A, B, C, and D forming a notional listed company group, entity A does not form part of the CBC reporting group with B, C, and D, as the exception to the requirement to consolidate for investment entities is not disregarded. So entity A would only ever be a CBC reporting entity if of itself its annual turnover exceeded $1 billion. Equally so in terms of entities B, C and D. D, however, would actually be required to be consolidated for accounting purposes with B and C, were entity B as a listed company, in this case disregarding the materiality exception for consolidation. So under this rule, actually, entities B, C and D will form a CBC reporting group and will need to file CBC reports. Again, the global income of the group would need to be $1 billion or greater for this to apply. I think we have a quick poll in relation to this one, just to see how you are in terms of whether SGEs apply to you. So please have a go at the poll and see whether you think you know which you are, and we'll keep that poll running throughout. Moving on to the hybrid mismatch rules and structured arrangements, I'll just do a quick recap of these provisions because currently we have a PCG 2019-6 and LCR 2019-3 that were issued back in July last year, which clarified the interpretation and design feature of a scheme, because these rules effectively resulted in many cross-border international structures coming on board which had hybrid offshore hybrids. So just to recap, a structured arrangement can include payments to unrelated parties under a structured arrangement and can also lead to the early operation of the imported mismatch rules as from 1 January 19 rather than the normal starting date of 1 January 2020 for the imported hybrid mismatches. A structured arrangement arises where the hybrid mismatch is actually priced into the terms of a scheme under which the payment is made, or in the ATO's view, it's reasonable to conclude that the hybrid mismatch is a design feature of the scheme under which the payment is made. And it's this second line which has brought a lot more companies into the net this year. Again, just very briefly, in terms of how the provisions work, first you have to consider whether the hybridity is priced into the terms. And again, any reference to the tax rate in the formula of the pricing, where there's a different market rate that is arising due to hybridity being involved, if there's a gross up renegotiation or break clause that occurs where the hybrid outcome is not obtained. And finally, it tends to be a case that only particular jurisdictions are the only users of this instrument, even though it may be globally available. Secondly, the other aspect is this design feature. And again, this is a reasonable person test. And so the intention is not irrelevant. It's not a purposive test. And so it really does turn on the facts and circumstances under an objective test. Again, the indicia the ATO points to here are whether it's marketed as a tax advantage product. Is it designed to create a hybrid mismatch? Is it offered to a particular jurisdiction of investors? Or do you actually end up with a negative outcome, but for the fact you have the hybrid mismatch as part of the scheme? There are a couple of exceptions, but many of these turn around whether you could not reasonably been aware that the scheme gave rise to a hybrid mismatch. And that's probably more in the case of a unrelated third-party structured arrangement that you entered into. Because under these other exceptions, there has to be no other entity in the 832 control group that could reasonably have been expected to be aware that the scheme gave rise to a hybrid mismatch. So though even though you in Australia may not be aware of it, if any other member of your global group is aware of it or could reasonably have been aware of it, you can have a hybrid mismatch arise. And again, the financial position of each entity in the division group would reasonably be expected to have been the same if the scheme had not given rise to a hybrid mismatch. So again, a really challenging thing for a lot of companies in Australia who have to really work closely with their overseas tax departments to understand better the nature of the whole global group. And again, critically here, for those companies looking to lodge their December 19 return in the coming weeks and months, you really need to come to a view as to whether you have a structured arrangement. And the gist of the ATO's current ruling and view is that the mere nature that if you've got a hybrid offshore, clearly that is a design feature of the scheme, and clearly you would be aware of it, or other entities in the group would be aware of it. So it is an example where the imported mismatch rules that many would have thought would be starting next year are actually coming on board quite early for this year, and you'll need to be considering it. Another hybrid mismatch issue that's out there is the targeted integrity rule, and there's an LCR in draft from 2019 that is yet to be issued finally, and this really focuses on the integrity measure. The integrity rule is focused on situations where the hybridity arises mainly because of the involvement of an interposed entity offshore. I always use the example of the classic hybrid instrument being an RPS, a redeemable preference share, which might be debt in one country and non-assessable equity return in another country. In this situation, you get a similar outcome, not from an RPS instrument, but from the interposing entity in between the Australian deduction and the parent company receipt of income. Again, the integrity rules requires the elements of an interposed entity. You have to be within an 832 control group, so it's for related parties. It is limited only to interest and derivatives, so it doesn't cover off cost of goods sold or other management fees. It's limited to those kinds of financial arrangements only. And the interposed entity has to be in a country which has a 0 or low rate of tax. And it could have a headline tax rate which is high, but maybe it is not taxing until the income is remitted to that country. So again, it could be the case that you're not subject to either subject to 0 or a low rate of tax. And then you have to consider whether the principal purpose test applies. In essence, this is again another facts and circumstances test, not of the interposed entity, but of the structure itself. We do look towards the source of the funding and whether there can be a conversion of this taxable interest payment in the ultimate end recipient's hand to a non-taxable return. Again, that similar result of being with RPS, except that it's the interposing of the foreign entity that helps you achieve that outcome. There is an exclusion if you're engaged in substantial banking, financial or other similar businesses, but this will not really cover most offshore pooling companies or similar simple finance companies in the global group. It needs to be doing quite substantial banking or financial activities. And there's a list of them covered off there in the summary. So again, if you've got a group finance company offshore, it is every likelihood that the targeted integrity rule applies to you if that group finance company is in one of those low or 0 rate countries. In an alternate scenario where the lending is coming from third parties, external lenders, or maybe from other parts of the group and it's being on-lent down to subsidiaries, you may be able to argue that there is a substantial business going on offshore in a banking nature, or it is clear that the funds are being sourced, the source of those funds is from other offshore lending, again, ideally third parties. Moving on to some other TDs around thin capitalisation. TD 2020-2 was released recently in relation to the valuation of debt capital for the purpose of Division 820. This covers off basically debt capital and the safe harbour amount calculations. Essentially, the ATO has come out and said that debt capital must be valued in accordance with the accounting principles, and that means you do not just confine it to the value of the financial liability appearing in the accounts. It must be valued in its entirety, whether regarded as comprised of debt interests, that are classified as either a financial liability, an equity instrument, or even a compound financial instrument under the accounting standards. Where the Commissioner thinks you haven't done that, the Commissioner is able to substitute a value they consider is more appropriate. Critical of this TD as both a prospective and retrospective effect from the date of its issue. The TD does include some simple examples of a loan note and a perpetual note, but in relation to this example, I'll just go into briefly the MRPS structure. This is probably a good example to see where the ATO is thinking. In this scenario, some MRPS has been issued with a cumulative dividend of 3.5% per annum, with a redemption within 9 years. Based on the terms of the MRPS, we're treating this as debt capital for the purpose of Division 820, but it is classified as a compound financial instrument under the accounting standards. For accounting purposes, it's valued at $30 million on the issue date, and it consists of both a liability component of $20 million, which represents the net present value of the redemption amount, discounted at market rates, and an equity component of $10 million, which is the difference between the transaction price of the instrument as a whole and the value of the liability component. Now, the ATO's view, and they do actually put out an alternative view as well, but their primary view in the tax determination is that the full $30 million will be needed, including your debt capital. So when you're calculating your total debt for the purpose of thin capitalisation, you'll need to include the 30, not strictly the 20 million. The ATO in the TD does address that argument that others say that the debt capital should be limited to liability, as that is where it is referred to in the Act. But the ATO's view is that the inclusion of debt capital against the liability is inclusive, and just reminding that the liability includes debt capital, but it does not limit it to their interpretation that you need to include both the liability component and the equity component in situations such as this. So again, this would increase the total debt of the group, and that will create you some issues for thin capitalisation purposes. Another point that's come out recently is the OECD has released finally some transfer pricing guidance on financial transactions. This has been long awaited for many years. It was issued earlier on in the year, and it's quite comprehensive in nature. It covers intercompany loans, your cash pooling, hedging, guarantees, and even into captive insurance companies. The gist of the guidance is that the substance of your transactions needs to align with the best economic interest of related parties, and that's this key consideration. And this our Australian TP rules will also focus on. They are expecting a high level of comparability, and the point they do make out in this ruling is, as with many OECD guidance, is as this guidance gets adopted globally, it is important to show that the financial transactions are at arm's length, not just in Australia, but in both jurisdictions to mitigate the risk of double taxation. Moving on to some more transfer pricing points, we'll just cover off now some revised guidance around the arm's length debt test, which was covered off in TR9 2019 D2. So again, another draft ruling that's long outstanding, but it is out there and it is designed to replace the former ruling on ALDT TR 2003-1. The key takeaway from this ruling is that there's expected to be an increased documentation burden. And this is really relevant for taxpayers now, because with COVID-19 and other pressures on, the safe harbour may not be a method that you can use. The worldwide gearing may be a difficult test to pass. So many taxpayers are now looking at the opportunity to access the ALDT. Again, the ALDT is just one of these options for determining a maximum allowed debt under thin cap rules. It does focus on being based on evidence, not the possibility. And here it's about a case of not what you could borrow, but what you would borrow. So again, it's really not about working out what is the maximum amount of allowance of debt you could get under the thin cap, under these ALDT rules, but what would be the appropriate amount of debt that you would seek. So again, all relevant factors need to be weighed and considered. And critically, there's an annual documentation requirement, which does lift the bar a bit, certainly for some companies. Again, just wrapping around that, there's a PCG out there which talks about the practical approaches, again, still in draft, issued mid last year. And it talks about some of the factors to consider, but also where the ATO and what they will do in terms of reviewing and applying compliance resources to the use of ALDT. Essentially, if the ATO has reviewed you before, you're okay. They've already reviewed you. They're not going to do much there. On the green zone, this is low risk inward investors. You'll see the list of dots here. It is quite commercial, third party lending, very limited facts here. If a lot of intragroup, a lot of associated debt within the group, you're going to struggle to meet this, especially if there's a guarantee or a security received from an associate. For the outward bound investors, probably you need to, as it says here, if you're widely held, publicly listed on the Australian Stock Exchange, that's a good fact pattern. You can't also be an inward investing entity, and you've got to have a credit rating which is equivalent to the Australian business's credit rating. So no arbitrage around the credit. Essentially, everyone else is in the yellow zone, the medium to high risk. So all other arrangements the ATO is saying they'll continue to apply resources. So quite a limited exemption. Look, that said, the ATO has been quite reasonable with COVID-19 lately, and they have come out and said that they're going to adopt a simplified approach for those who are relying on the ALDT, especially those who've now had to rely on ALDT due to COVID-19 impacts on their balance sheet. Again, the ALDT says they will apply a simplified ALDT approach, but they still expect taxpayers to use best endeavours to apply all criteria of the arm's length debt test. For the inward invested entities, and this is not those who are also outward investing, they've also gone on to say that no additional related party funding should have been received recently, other than say some short-term debt facilities. So COVID-19 and this relief is not an excuse to rack up additional debt, because the ATO's expectation that any new debt coming into the group would actually come as, any new capital coming to the group would come as equity. And also the ATO said this would not apply usually where, for example, dividends have been paid. If you've paid dividends, you've already reduced your balance sheet position. So this relief will not be available to you. And again, the ATO says overall, if you're falling into ALDT because of this, we're not going to dedicate compliance resources to you, other than obviously to check that you can justify that you're into the ALDT and away from the safe harbour because of COVID-19 impacts. So just to wrap up in terms of the ATO compliance approach, I would just note that most other ATO compliance matters are delayed, not deferred. Streamlined assurance reviews are ongoing. Obviously, the ATO has been very busy supporting JobKeeper and other schemes, so that a lot of reviews and process our clients are involved in have been delayed a bit longer. But there's no apart from a few of these things we've noted today, there's not much out there the ATO is going to do other than just take more time to get these things underway. There's still areas the ATO wishes to focus on.
Thanks a lot, Tim. And I'd like to also thank all of our speakers today. We've endeavoured to provide you with some really high-level comments and on what is really some quite specific and complex tax legislation rulings and cases. I'd like to thank Jay DeBrincat, who has been answering some of the questions through the Q&A throughout today's session. If you'd like to obtain some additional information, you can access it through our website. The details are on the screen. We do have a dedicated COVID-19 web page, which I think a lot of you have probably already seen or accessed. Also, we do post quite a bit of tax content through our LinkedIn channels, so please feel free to follow us through LinkedIn. The details are on the screen there. We'd also like to hear from you if you want any more details on these sort of complex issues. Obviously, our presenters today, I think, have done a great job trying to get through what is really complex issues in a simple format in quite a short space of time. But obviously, going forward, if any of these issues impact on your business, please feel free to speak to any of our panelists with their details there that are on the screen. Would also like to let you know that the slides will be sent out shortly to everybody who's attended. The presentation has been videoed, so we will also post the video and people can go back and have a look at some of the insights that have been provided by our presenters. So I'd really like to thank Tim, Matt and Helen for their presentations today. We do have a couple of key takeaways, I think. I think in respect of JobKeeper, we do see it's going to be very important to document the position of how you arrived at your decline in turnover, because we have seen the ATO already putting out guidance on this, is that they are expecting a fair bit of documentation. Also, we have done a poll on the SGE issue, just to get a bit of a feeling for how many people this is relevant to. It is quite a significant change, but it will be quite limited, and our survey does show that as well. So just from our attendees today, we have 11%, which is 19 people who have responded who are subject to the SGE rules. We've only got 2 who these changes will impact on the line. There's a couple of people who weren't quite sure whether it will impact them or not. They need to find out. So, but yeah, obviously with the people on the phones today or on their dial-in, we had around 54% who they're not SGEs, but it's just some useful information just to see what changes will be, because that will require a fair bit of extra guidance going forward if you have to comply with country by country reporting. But if you have any questions about SGEs, please feel free to contact any of our international tax experts at Shine Wing, and all the presenters today are very well versed in these issues. We'd also value your feedback on the session, so please complete the feedback survey, which will pop up at the conclusion of the webinar. I think we've done pretty well. 2 minutes, it's at 2:58. We also wanted to highlight that a lot of you have already subscribed for our next session in this series, which is on Thursday next week, the 11th of June at 2 p.m. This session is going to be a bit more interactive. We will be refocusing our attention on the practical year-end matters, in particular, how we're going to deal with all these COVID-19 changes going forward. So I think that'll be a great session, and encourage people to come along to that one as well. So we'll give you some really interesting insights there. So thanks a lot, everyone, for joining us. Be well, stay healthy, and we look forward to speaking to you soon. Thank you. Bye.